on the latest inflation data, 4.9%, which is less than 5% as the inflation number that was recorded in March. It's slowing, but only marginally. What do you think is the way forward, and how do you read this?
Hi. First of all, yes, the US CPI has dropped marginally lower, actually, from the 9.1% peak that we saw earlier on last year. So it is definitely a wider gap there. We've seen that inflation drop down by a lot, from 9.1% to 4.9% after a lot of 0.75 rate hikes, and now a 0.25 rate hikes. So there definitely could be a pause. Actually, traders are now assuming and anticipating in the Fed meeting that there's likely going to be a pause. This is suggested by obviously the positive figure from the CPI, and also the NFP figures suggested otherwise last Friday, when the labor market still remains strong. So the Fed does have the capacity to increase rates furthermore. So now we wait and we see, but on the CME tool, according to CME, more than 80% of analysts and traders do believe that we're going to see a Fed pause.
You're saying that you're going to see a Fed pause. However, the Fed has categorically stated that it's quite flexible as far as hiking or reducing rates are concerned. But Nadia, you sound very optimistic. However, let me bring you to our next question, which is the fact that the CPI number is still well above Fed's desired rate of around 2% to achieve stable and sustainable growth. Now, how will that be achieved, and how long do you think it will take for inflation to come down to that figure?
I think by the end of the year, we could definitely reach the 2% target, but I do believe that there will be more rate hikes required. I mean, it is possible for the Fed to pause on that cycle. However, it is working. Inflation is dropping down. There's a good drawdown to that. But the only thing here is the negative aspects that we have on the economy in terms of labor market or retail sales and different kinds of economic indicators. So that will majorly depend on the economic indicators that we do receive. And just like I previously stated, the NFP did prove that the labor market remains intact. And so this is up to the Fed to now decide whether they want to weather another storm of rate hikes, or is it enough for businesses and in general for banks to increase that interest rate percent on borrowing, because it does have a negative scope to it in terms of affecting individuals.
And talking about the global macroeconomics, now there's a liquidity crisis in the United States. Banks are getting affected. Markets are already hesitant. And then very recently, we also heard of the debt ceiling crisis, which is again one of the most pressing issues. What does the path look ahead? Very briefly, Nadia, if you could answer that, because we're running out of time.
Yes, so definitely we're reaching a debt ceiling, but the only reason for us to, or the only tool that we have is to increase the debt ceiling, which we've seen multiple times and many years ago that every time that we reach the debt ceiling, they put more chances of us raising that ceiling. And I think that's the only tool that we have left. Otherwise, they could use some of the fiscal policy budgets that they've contributed to other sectors to allocate them to the debt ceiling crisis, as well as us suffering from the banking crisis, which we're likely more to see more banks suffer from this as it falls in line with the domino effect.